If you were born before 1960 and you are collecting Social Security, there is a very real chance the IRS is quietly taxing a portion of that check right now, and not a small portion. Under the rules in place this year, up to 85% of your Social Security benefits can be pulled into your taxable income. Most people have no idea this is happening until a tax bill shows up, and they are left staring at it, wondering how the government can tax a benefit they paid into their whole working lives. So today I'm going to walk you through exactly how this works, in plain English, and I'm going to show you the one rule that almost every senior misses, the rule that quietly drags more and more middle-class retirees into this tax every single year. And if this has been happening to you, I want you to hear this clearly. It is not your fault. Nobody at the Social Security office sits you down and explains it. The rule is buried in the tax code, the numbers that trigger it were set decades ago, and there is no warning letter in the mail. I went through the current federal rules for this year, and there are a few specific things you need to understand. But there is one in particular, one rule most seniors completely miss, that decides whether you hold on to your money or hand a chunk of it back. I will get to it. Stay with me all the way to the end, because I am also going to show you a brand new deduction that can wipe out a large part of this tax for many of you, but only for a few more years, and only if you know it exists. Before we go further, do me one quick favor. Hit that subscribe button and turn on notifications. The seniors who understand these rules are the ones who keep more of their own money. The ones who do not are the ones who find out when it is already too late to do anything about it. I do not want you to be in that second group. Now, let me start with the question that scares people the most, because the answer is going to relieve a lot of you. When you hear that up to 85% of your Social Security can be taxed, does that mean the government takes 85% of your check? Hold that thought for just a moment, because the real answer matters enormously, and getting it wrong causes a lot of needless panic. Here it is. 85% is not a tax rate. It is not the slice they take. It is the maximum share of your benefits that can be counted as taxable income. In other words, at the very most, 85% of your benefit gets added to the pile of income the IRS looks at, and then it is taxed at your ordinary rate, whatever that happens to be, often 12%, sometimes 22%. So, if your benefit is $2,000 a month, the government is not taking $1,700 of it, not even close. And here is the part worth remembering. No matter how high your income climbs, at least 15% of your Social Security is always protected. It can never be taxed. So take a breath. The headline sounds far worse than the reality. So how does the IRS decide how much of your benefit gets taxed? It comes down to a single number, and this is the number I want you to find, because it is probably sitting in your tax documents right now. The IRS calls it your combined income, and the formula is simpler than it sounds. You take all your other income for the year, your pension, your retirement account withdrawals, any wages, then you add any tax-exempt interest you earned, and then you add 1/2 of your Social Security benefits. That total is your combined income. That one number decides everything. If you can calculate that figure, you can know exactly which tier you fall into, and you can do it in about 2 minutes with the papers you already have. Now here are the lines that matter, and I want you to write them down. If you file as a single person and your combined income is under $25,000, none of your Social Security is taxed. Between $25,000 and $34,000, up to half of your benefits can be taxed. And above $34,000, you reach that up to 85% ceiling. For married couples filing jointly, the lines are $32,000 and $44,000. Below $32,000, nothing. Between $32,000 and $44,000, up to half. Above $44,000, up to 85%. And one warning for married couples who file separately but live together during the year. In that situation, up to 85% of your benefits can be taxable from the very first dollar. There is no safe zone. Let me make that real with a quick example, because numbers on their own can be slippery. Say you were single and you collect $24,000 a year in Social Security. On top of that, you take $18,000 from a pension and a retirement account. To find your combined income, you take that $18,000 and you add half of your Social Security, which is $12,000. That puts your combined income at $30,000. $30,000 sits inside that first band, between $25,000 and $34,000, so up to half of your benefits can be taxed, not the full 85%. Push your other income higher, though, and you climb toward that upper line. You can see how quickly ordinary income moves you up the ladder. Now stop, because here is the question that unlocks everything, and the answer is the rule that almost nobody knows. Why are more and more middle-class retirees getting hit by this tax every single year when they are not actually getting any richer? The answer is one word: frozen. Those threshold numbers I just gave you, the $25,000, the $32,000, the $34,000, the $44,000, were written into law back in the 1980s and 1990s, and unlike almost everything else in the tax code, they have never once been adjusted for inflation, not a single time. Think about what that means. Every year, your cost of living raise bumps your benefit up a little. This year, that raise was 2.8%. Your other costs rise. Your withdrawals rise. But those lines in the sand never move. They sit exactly where they were set decades ago. So a retiree who is no wealthier in real terms, who is honestly just trying to keep up with prices, gets quietly pushed over a line that has not budged in 30 or 40 years. That is the rule most seniors miss. The goalposts are nailed to the ground, and every cost of living raise nudges more of you across them. And let me give you one more trap inside this because it catches careful people. A lot of seniors move money into tax-exempt municipal bonds, thinking that income is invisible to the IRS. For most purposes it is, but not for this. Tax-exempt interest still gets added back into that combined income number we talked about. So the very thing you bought to lower your taxes can quietly push more of your Social Security into the taxable column. It is one of the few places in the whole tax code where tax-free income still counts against you. All right, I promised you relief, and here it is. And this is genuinely new, so pay attention. Starting with the 2025 tax year, there is a brand new deduction just for seniors. If you are 65 or older, you can claim an extra $6,000 deduction. If you are married and you are both 65 or older, that is up to $12,000 combined. And this stacks right on top of the extra standard deduction seniors already get. You do not have to itemize to claim it. It works whether you take the standard deduction or not. Now, why does this matter for the tax we have been talking about? Because this deduction lowers your income, and lowering your income can pull your combined income back down below those frozen thresholds. For a lot of lower and middle income seniors, it can shrink the tax on your Social Security, and in some cases, erase it entirely. But I am going to be straight with you about the catches, because that is what we do here. First, this deduction is temporary. It is only good for the 2025 through 2028 tax years. Unless Congress extends it, it disappears after that. Second, it phases out for higher incomes. It starts shrinking once your income passes $75,000 as a single filer or $150,000 as a couple, and it has gone entirely well above that. And third, despite all the talk you may have heard about no tax on Social Security, I need you to understand that this did not eliminate the tax on your benefits. It is a deduction, not an exemption. The 85% rule is still right there in the law. This just gives many of you a powerful tool to soften it. So what should you actually do with all of this? First, go find that combined income number using the papers you already have, so you know which tier you are in. Second, if you are 65 or older, make sure that new senior deduction gets applied. On the standard tax form, it is handled automatically once you enter your date of birth, but check that it is there. Third, if your income is sitting right near one of those frozen thresholds, this is where timing matters. Spreading out retirement account withdrawals or being careful about when you do a Roth conversion can keep you under a line instead of over it. Fourth, if you would rather not get a surprise bill, you can ask Social Security to withhold taxes from your monthly payment directly. And fifth, remember most states do not tax Social Security at all. Only a handful still do, so check your own state's rules to be sure. Let me bring it all together in one breath so it sticks. Up to 85% of your Social Security can be taxable, but that is the share counted as income, not a rate, and at least 15% is always safe. It is decided by your combined income. The thresholds that trigger it have been frozen for decades, which is why more ordinary retirees get caught every single year. And there is a new $6,000 senior deduction that can ease the burden, but only through 2028. The IRS is never going to call you up and explain any of this. You have to know the rule and run your own numbers. If this made the picture clearer for you, do one kind thing. Send it to someone who is on Social Security, a parent, a spouse, a neighbor, an old friend. A lot of people are overpaying or panicking simply because no one ever explained how this actually works, and a few minutes of clarity could save them real money. And one last thing, because it matters. Everything I shared today is for education and general understanding only. It is not tax advice, and I am not your accountant. These are the federal rules for this year. Your own situation can have wrinkles, and state laws differ. So before you make any decisions, confirm the details using the official worksheets at irs.gov, or sit down with a qualified tax professional. Know your number, know the rule, and keep more of every single dollar you have earned.